Hello! 2024 has been a year of elections in many of the world's biggest markets for private investment in infrastructure. But where are investors looking now for the best opportunities? This year's elections mean new governments are coming to power. So which countries are offering the best prospects for investors, political stability, the most attractive policy frameworks, the fewest barriers to investment, and the strongest incentives? In short, who's winning the global race to secure private capital? These are the questions we ask of the world's leading infrastructure investors every 6 months. And our latest Pulse survey, published in this month of December, comes as the leading markets all wrestle with new political realities. The United States awaits President-elect Trump. The new UK government has put private investment at the heart of its growth agenda. And the newly reappointed President of the European Commission has set out her ambition to head what she's called an investment commission. I'm Simon Montague, and welcome to Talking Global Infrastructure, the podcast from the Global Infrastructure Investor Association. Today, we're talking about our latest 6-monthly Pulse survey of investor sentiment, a survey that offers a unique insight into which geographic markets are looking most attractive to investors and which infrastructure sectors seem to be offering the best returns. It's insight that's available nowhere else, and we do this survey in partnership with the global business performance consultancy Alvarez Marsal, from which I'm joined by 3 managing directors covering the core markets. Wayne Jephson is a specialist in infrastructure transactions based in London. Moody heads the energy and infrastructure practice and joins us from Atlanta in the United States. And Craig Forrest leads the firm's infrastructure and capital projects team in Europe. Gentlemen, you're all very welcome. Right, first of all, let's set the scene. 2024 has been a year of elections in the US, the European Union and some of its member states, and in the UK. And all these against a backdrop of geopolitical uncertainty, wars in the Ukraine and Middle East, increasing fears over the speed and costs of tackling climate change, and deglobalization and what that means for international supply chains. So, not an easy year for investors looking for long-term stability in which to invest in the energy, transport and digital networks that connect us all together. Let's look first at the US, and Jay, perhaps I can start with you. What do you think has been the impact of the election campaign on the ability of investors both to raise funds for investment and on their willingness and ability to actually deploy those funds into infrastructure assets?
I think the election being in the rearview mirror is going to be a positive for the next year. Overall, sentiment post-election is good, with the expectation of less regulatory scrutiny and stabilized or even possibly declining interest rates. The fundraising environment should be buoyed by the denominator effect of record high public equity values, causing a need for more private equity investments.
Is there anything you've heard from Donald Trump on what he says he'll do that does, you think, cause anything in the way of denting investor confidence?
Well, as most of you probably have heard, Trump's goal is for America to be energy dominant and focus on maximizing domestic oil and natural gas production in the United States. Confidence is high that energy investment and the related midstream infrastructure will increase. Permitting for new pipelines needed for power generation and data center development will likely become more attainable. There's a general view that electric vehicles and renewable assets may have some headwinds, but otherwise sectors like transportation, digital infrastructure, and conventional energy are all expected to have a tailwind and to see higher deal volumes. Anecdotally, in the last month, we've seen a significant increase in new buy-side deal activity at our firm. Much of this was anticipated no matter which political party won the election due to the reduced uncertainty of the direction of government policy, but that bullishness on the pro-business environment in the United States is palpable right now.
It sounds a pretty encouraging picture, even though I have to say, in the survey, we did see the United States decline slightly in terms of investor sentiment as that election campaign was running.
That's right, Simon. I think that's really a timing difference, with perceptions of a neck-and-neck race between the Democrats and the Republicans at the time of the survey. The U.S. results reflected an uncertain environment during a long run-up in the election. Since the elections have ended, conversations with, I think, members and the market reaction more generally suggest that we'll see a strong upturn in sentiment next year. Overall, the infrastructure investment sentiment in the U.S. and the Market Pulse survey still remain more positive than any other areas except for Australia.
Craig, can I turn to you and looking at Europe? My sense from the survey is that the equity fundraising environment has become less favourable in recent months, and with ongoing political upheavals in France and Germany, may be getting even worse. Is that how it looks to you?
Well, sentiment has deteriorated over the last 6 months, and as you said, there remains political challenges in Europe, with significant investment markets of France and Germany continuing to experience political disruption. That said, macro trends are starting to point in the right direction globally, with interest rates and inflation tracking to a more stable and acceptable place. Sentiment for 2025 for fundraising is cautiously improving. However, with the threat of tariffs now coming from the US, it is unclear how this will play into fundraising and the attractiveness of infrastructure over other asset classes. But I'm cautiously optimistic the long-term fundamentals remain overall strong for infrastructure and fundraising in 2025.
And Wayne, it's your turn. The UK government's now been in power for nearly 6 months. What would you add about fundraising and indeed deployment from a UK perspective?
Thanks, Simon. I'd simply say that many funds remain long on UK assets, which means you need a compelling reason to allocate funds to the UK. Currently, that compelling reason doesn't really exist in many subsectors of infrastructure. Whilst investors may have typically turned to Germany and France as alternatives, recent events are denting the confidence of investing in these territories too, meaning that investors are once again seeing the Nordics as a haven of relative stability, as well as seeking out opportunities in other European countries that haven't historically attracted huge amounts of infrastructure investment.
Let's come back to the US and have a bit more of a dive into what the Pulse survey is showing about the US. If we think back, it's been, top of the tree now for probably about 4 years since Biden's infrastructure bills were introduced. And we've seen this survey take place in the course of the election campaign, so before it was actually known who the winner was going to be. Where do you think the Pulse survey might be looking by the time we take the next one, which will be next spring? What sort of reaction might we have seen from investors as the next 6 months come to pass?
As you alluded to this, the survey was completed just before the election of President Trump was confirmed. So perhaps in terms of the existing survey, it's too early to see how this has impacted investors. However, many of the assets infrastructure investors are interested in are GDP linked, particularly in the transport and core plus environments. Any tariff increases will impact international trade volumes, particularly through the European port infrastructure. It will also impact the pound euro in people's pockets as tariffs increase prices, which will impact other transport assets such as airports. However, perhaps from my perspective, the biggest impact will be the impact of tariff-driven inflation on the trajectory of interest rates.
Well, the pace of economic growth is, of course, fundamental to investors. And growth in GDP generally means growth in demand from the assets that investors own. But now President-elect Trump is threatening tariffs. Wayne, what are investors in Europe and the UK making of this?
Already expected to remain higher for longer, they may remain higher for longer still, which continues to make it tricky for investors to achieve the returns on core infrastructure assets, which have historically traded at single-digit IRRs.
Jay, let's just talk a little more in detail about the US. There seems to be a lot of bullishness in most areas, as you were saying a minute ago, but there is one sector, I think, that perhaps people might be looking at a little more nervously. Can you talk to me a bit about what that sector is? Tell our listeners what we're talking about here.
Yeah, sure. In general, I would say the renewable energy sector and everything around electric vehicles has probably seen the largest decline in interest from some of the investors that we've spoken with. It really has to do more with the economics, and now with the Trump agenda being a little bit more on the conventional oil and gas side, I think there may just be somewhat of a lull in new activity or new fundraising for some of these investments in the renewable space. It may actually create opportunity, of course, because less competition creates more opportunities for making good deals. But in general, I do expect maybe a slight decline on the renewable side, particularly if there are changes to things like the Infrastructure Reduction Act or BEAD funding on the digital side coming out of the Trump presidency, which is all to be determined at this point.
Craig, if I may return to you again regarding the European Union, what in particular in between sectors do you see as being perhaps the differences in how investors are regarding one infrastructure sector against another?
Sustainable generation and data centres continue to be the flavours of the month. Across all regions, decarbonisation policies are creating opportunities for investors. And it's a sector that requires innovation private finance brings to create opportunities that have real impact. AI demand is also fueling continued growth of the data centre market. And data centres require significant power, and we're seeing an interest in conflation of these two investment classes, even seeing investment in nuclear power into data centres. In the traditional infrastructure asset classes, ports, cargo terminals, railways, and rolling stock, they've remained attractive, and we've even seen airports coming to the market and changing hands as traffic returns to pre-COVID levels. However, aviation is not for everyone, and there remains some skepticism when investors are looking at airport opportunities.
Why do you think that is, that investors are still sceptical about airports, even though traffic levels have returned?
I think people have got very short memories. Traffic levels are only coming back to where they were pre-COVID, not all of them. And people remember that what happened as a result of COVID and how revenues very, very quickly get turned off. I think sentiment-wise, it'll take a bit of time for confidence to return. However, we are seeing people coming back into that market. They are very attractive, and you've got prize assets like Heathrow, which are significant checks changing hands. So I think it's just proximity to the issues of low traffic. However, I think investors, that gets into the rearview mirror, will pile back into that sector.
Wayne, Craig mentioned there Heathrow, and you're, of course, if you like, boss of the UK patch amongst this triumvirate of experts we've got on this show. Whereas voters in the EU and the US both moved to the right, in the UK, they've moved to the left. Labour won that huge majority back in July. And this new government, new Labour government, has been talking about putting private investment right at the heart of its economic growth agenda. Is that yet having any real effect on how investors feel about the UK?
If you look at the results of the survey cold, bearing in mind it was completed in the immediate run-up to the Rachel Reeves budget and perhaps before investors had a chance to digest the outcome, you have to say that the answer is no, not really. Respondents still have the UK languishing at the bottom of the pile of attractiveness among major European economies, despite the uncertainties in France and Germany. In fairness, it's probably still too early to tell. The government's intentions to combine local government pension schemes into mega funds and increase spending on infrastructure projects is clearly positive. However, whilst the regulatory regimes are still considered to be relatively unattractive, with the water sector remaining on the front pages of the newspapers, it will continue to dampen appetite.
Yes, I was going to mention the water sector because of the publication by Ofwat of its final determinations on how much water companies can invest and charge their customers over the next 5 years. It means that investors can begin to assess what the announcement means for them. Now, how important is this moment for shaping investor sentiment towards the UK as a whole?
In my mind, it's a pivotal moment, Simon. The water companies have had an interesting journey since privatisation. If you just go back a little bit and think about how the sector has developed, if you look at AMP1 to AMP4, it's fair to say that environment was very positive for investors. Solid investor returns were made off the back of financial leverage, while capex allowances stayed below the long-term trends required to renew the network. The end customer was, however, blasé, as bills didn't grow in real terms and the network still functioned adequately. In AMP5 to AMP7, water regulation has become a political hot potato, and that's continuing as we move into AMP8. Ofwat has been keen to keep a lid on prices in the last 3 reviews in response to political pressure for affordability for customers, and the flip side of that coin has been pressure on capex programs, meaning the network continues to age and the front page stories of sewage discharge have grown. Clearly, investors at times have not done themselves any favours in managing the narrative as this story has played out. However, Ofwat has an opportunity to reset the clock and create the environment for a move towards an equilibrium between consumer affordability, network investment and investor returns. It won't be easy, but it is a critical step to improving both the outlook for the water sector and the wider view of the attractiveness of the UK as a place to invest private infrastructure capital.
You use the acronym AMP there. Can you just explain what that is?
Yeah, essentially, Simon, that's the 5-year regulatory period beginning in March 2025 and ending in March 2030.
Yeah, and so the other AMPs were all 5-year periods before AMP8, which is the current one, which is just about to start.
Yeah, essentially. So at the end of AMP8, we'll have had 40 years of water privatisation in the UK.
Now, wherever they look, investors are always considering any barriers to investment, and if they're too big, the risk is they'll simply go elsewhere. And this GIIA Pulse survey does ask investors about 6 broad categories of barrier: lack of project pipelines, unattractive regulation, lack of funding models, restrictions on foreign direct investment, uncompetitive and tax regimes, and political instability. And frankly, if you had all 6 of those barriers, then you probably definitely would go elsewhere. But Craig, we were talking before we recorded this podcast a bit about the sort of barriers which you've spotted are going on in Europe. What sort of thing would you highlight as being a potential barrier to investors?
Talent is a major consideration when making investment decisions. Investment theses require businesses to be scaled, new technologies to be put to work, and aging assets to be replaced. Investors being able to access finite talent and having the confidence in those implementing their investment thesis in such a challenging market is important. As we've discussed, there are many other imponderables, and investors want the talent working for them to control the things that they should be able to control when they're making investments.
Jay, looking at the US, as you do, there's a couple of potential barriers in this list which might apply under a Trump government. Restrictions on foreign direct investment, who perhaps could translate that loosely as tariffs, and political instability. You never know what President Trump's going to do next. I don't know which of these categories of barrier you might think might be most applicable to the United States.
Yeah, in the U.S., I would say there's a general view that tariffs will be coming on foreign goods, and that will increase cost if you're importing a significant amount of the inputs for example, your data center with all the AI requirements. And so I do expect that there will be an increase there. The political instability and sentiment element that we capture in the survey is one that I think was fairly high for the U.S. as being a concern in the last survey. It's going to be very interesting to see what that looks like in the next survey, right? Which will have captured all the changes that are expected, including the DOGE, right? The Department of Government Efficiency that allegedly is going to come along and really make the government more efficient. But it also there may be other areas that impact infrastructure investors as well, as we see the new Trump regime come into office. So I would say that was actually a relatively high amount in the last survey, and it'll be interesting to see if that is reduced or goes higher. It may depend upon the investors' focus and whether or not they're focused more on renewable energy transition as compared to some of the more traditional, conventional oil and gas, midstream, and some of the other sectors like transportation.
And Wayne, just finally, we've talked, I think, already a little bit about how water regulation is probably the single biggest barrier to investment in any sector in any country, as shown by our survey of our members who are infrastructure investors around the world. Is there anything else that actually matters in the UK, or if water regulation is settled as an issue, is it just all plain sailing for the UK to rocket back up to the top of the charts in terms of investor attractiveness?
So yes, I mean, I think obviously the water sector has caused a lot of noise and a lot of column inches in newspapers over the last 6 months, 12 months, even 2 to 3 years, and has been a big ticket item that has put off a number of investors in the UK, particularly as I think you mentioned earlier, a number of funds have actually said that the UK water sector is uninvestable. I think getting the water sector back on a stable regulatory footing will be very helpful in turning around the sentiment towards the UK. That said, there are a number of other sectors which aren't exactly operating perfectly either. The UK fibre sector being another where there has been some notable difficulties among investors in the space as a result of a regulatory environment which has essentially encouraged investors to overbuild and build alongside each other, which is making it difficult for fibre investors to make returns in that space as the level of penetration has been below expectations on the networks that have been rolled out, and the costs of rolling out those networks has also increased. There'll continue to be a few column inches around that sector in the next few months and years, I've no doubt. But those two sectors aside, most of the sectors have a relatively positive view in my mind.
Good. And I think governments around the world are all hugely conscious of the burden on private infrastructures to help them close the infrastructure funding gap between what governments can afford and what citizens are actually looking for these days. So hopefully overall, the prospects for infrastructure investors remain very good. Anyway, that's all we've got time for. Thank you very much to Wayne, who's been talking to us about the sentiment towards the UK market, Craig, who's been talking to us about prospects in the European Union, and Jay, for your kind thoughts and guidance, if you like, on what's going on in the United States. Thank you all for joining us on Talking Global Infrastructure, together with my experts from the business performance consultancy, Alvarez and Marsal. You can find out much more about our latest Pulse survey and more insight and articles on our website at GIIA.net. You can follow us too on LinkedIn for the latest industry news. Please do join our mailing list for our monthly bulletins about what we're doing and the events that our members are welcome to join. And I hope you've enjoyed this episode. You can follow us on Spotify, Apple Podcasts and YouTube, so you definitely catch our next show. And just finally, if you've got an idea for a future podcast, something you think we should be talking about, then simply email me at communications@giia.net. I do hope to hear from you. Goodbye.